The Australian equity market rebounded strongly in the June quarter, with the S&P 300 index total returns rising almost 17%. Australia was one of the best performers amongst global markets that were universally strong. Local economic data was weak, although somewhat less so than feared. Notably, first quarter GDP fell a modest 0.3%, and initial expectations around rising unemployment proved excessive. Consumer and business sentiment also improved markedly. The Australian government 10-year bond yield rose 11 basis points to close at 0.87%. The Australian dollar strengthened materially against the US dollar and is now trading modestly above pre-pandemic levels. Commodity prices were also generally improved, including oil, iron ore and gold. Looking at performance by sector, information technology was strongest, then consumer discretionary. The Maple-Brown Abbott Australian Share Fund, wholesale units on an after-fee basis, produced a total return of 14.7%, underperforming the market by 1.8%. The largest positive contributor to performance was our decision not to hold CSL, down 3. After outperforming strongly during the downturn, improving market sentiment saw money flow away from CSL and other defensives. While CSL has now fallen materially from its peak, it still trades on nearly 40 times forward earnings, and we continue to view it as expensive. Our overweight position in Boral, up 85%, performed very well. The stock had been heavily impacted by COVID-related concerns for the US and Australian housing markets and some perceived balance sheet risk. The stock's strong performance over the quarter reflected an improving economic outlook, with fears around an equity raising as yet unfounded. The emergence of Seven's Group Holdings as a major activist shareholder and the appointment of a well-respected CEO successor were also favourably received. The key negative contributors to performance were underperformance from a small number of value stocks held by the portfolio, our decision to avoid strongly performing hyper-PE technology and gold stocks, and the outperformance of small companies. Of stocks not held, a small group of outperforming technology stocks detracted almost 1%, with Afterpay Touch Group up over 200%, the largest single contributor. While some of these stocks may be relatively unaffected by COVID-19, or indeed benefited from an accelerated shift online, the valuations are often incomprehensible. As a group, they are trading on a forward PE of nearly 90 times. Our market continues to have pockets of significant overvaluation, unsurprisingly in the healthcare and tech-related spaces, but also general industrials. The stocks in these segments have benefited from exceptionally low interest rates being used to capitalise long-dated earnings in what are often opaque business models. There seem significant overlaps today with what we saw during the tech bubble, as well as the Nifty 50 period in the early 70s. Neither of these periods had happy endings for investors. Tech stocks globally have been a prime beneficiary of the current environment, some benefiting directly from a further switch to online activity, while others have been relatively untouched by the economic slowdown. For many of these stocks, not having to downgrade profits has been helpful. It is difficult to downgrade something you don't have. The Nasdaq has put on over 50% from its March lows to reach a new all-time high during June. We see a similar picture in Australia with the extended strong run of performance from the tech names, near doubling their market weighting over the last 18 months. Tech remains a valuation agnostic space. The stocks included in the chart have a market capitalisation of approximately $95 billion and earnings of $1.1 billion. Investors who are active during the tech bubble will remember many similar extreme valuations for tech-related stocks that then quietly disappeared. By way of contrast, the combined market capitalisation of Brambles, Coca-Cola, Coles, Orica and Woolworths, stocks which are, or until recently have been held across our portfolios, is similar, but the profit metrics are vastly different, with the attributable profits over 4 times larger.